Imagine it's early 2024. You're a 53-year-old commercial real estate developer in downtown Chicago. You own a 26-story office tower on South Wacker Drive. You bought it in 2019 for $140 million. The loan was generous. The rate was low. The tenants were locked in. Everything made sense. Now you're sitting in a conference room on the 14th floor of your own building, and 6 of the floors beneath you are dark, empty. The law firm on floors 9 through 12 left 18 months ago. They didn't downsize. They just didn't renew. Their associates work from home 3 days a week now, and nobody needs 60,000 square feet to house people who aren't there. The insurance company on floors 5 through 8 consolidated into a smaller space in the suburbs. Rent was cheaper. Parking was free. Nobody complained. Your loan matures in 11 months. You owe $92 million. You call your lender, a regional bank headquartered in Missouri, to discuss refinancing. The conversation lasts 9 minutes. The bank's commercial lending officer tells you, politely, that the property would need to appraise at a value that supports the outstanding debt. You both know it won't. The building, if it were listed today, might fetch $75 million, maybe, if a buyer existed, which at the moment one doesn't. You are not bankrupt, not yet. But you are sitting inside a building that is quietly becoming worth less than what you owe on it. And you are far from alone. This is not a story about one building. It is not a story about one city. It is a story about what happens when an entire asset class, one of the largest in the world, slowly loses its value while the debt pinned to it stays exactly where it is, and the financial system pretending that the gap between those two numbers doesn't exist. This isn't theory, it's balance sheet arithmetic. And once you see the math, you understand why so many people inside the system are quietly terrified and why almost nobody outside it is paying attention. Most people, when they hear the phrase commercial real estate, think about skyscrapers, glass towers in Manhattan, shopping malls, maybe a warehouse. They think about it the way you'd think about a building, a physical structure, something solid. That's not what commercial real estate is inside the financial system. Inside the financial system, commercial real estate is collateral. It is the asset against which trillions of dollars of loans were issued. It is the thing that sits on the balance sheet of your regional bank and makes that bank appear solvent. It is the thing that pension funds bought slices of through mortgage-backed securities. It is the thing that municipalities tax to fund fire departments and public schools. Commercial real estate isn't just real estate, it is the connective tissue of an enormous financial architecture. And when the value of that tissue begins to decay, everything attached to it starts to weaken. Here is what most people think is happening. They think remote work reduced demand for office space. They think some buildings are emptier than they used to be. They think this is a slow, manageable adjustment, a post-pandemic correction, a normalization. Here is what is actually happening. The largest refinancing wave in the history of American commercial real estate is underway. Over $1.5 trillion in commercial real estate loans are scheduled to mature between 2024 and 2026. These loans were originated during a period when interest rates were near zero, when occupancy rates were high, and when property valuations reflected a world that no longer exists. Those loans must now be refinanced in a world where interest rates have more than doubled, where office vacancy rates in major American cities have reached levels not seen since records began, and where the buyers who would normally absorb distressed properties are standing on the sideline because they too cannot get affordable financing. The constraint is mathematical. It is not emotional. It is not political. It is the gap between what these properties were assumed to be worth when the loans were made and what they are actually worth now. And that gap is not closing. It is widening. To understand why this matters, you have to understand a mechanism that most people never think about. It's called the loan-to-value ratio. Every commercial real estate loan has one. It is the relationship between the amount of the loan and the appraised value of the property. When the loan is originated, this ratio typically sits between 60 and 75%. The property is worth more than the debt. The bank is protected. The math works. But here's the mechanism that breaks it. The property doesn't have to go to zero for the math to fail. It just has to drop below the outstanding loan balance. When that happens, the loan is what's called underwater. The borrower owes more than the building is worth. And when that borrower goes to refinance, no new lender will touch the deal at the same terms. The borrower must either inject new equity, tens of millions of dollars in many cases, or accept a much smaller loan with a much higher interest rate, or default. Now scale that across hundreds of billions of dollars of maturing loans. Scale it across every mid-tier office building in San Francisco, Los Angeles, Chicago, Houston, Washington, D.C., and New York. Scale it across suburban office parks, regional shopping centers, mixed-use developments that were financed during the cheapest credit environment in modern history. This is not a crisis of bad actors. Nobody committed fraud. Nobody lied on applications. The buildings were real. The tenants were real. The rents were real. What changed was the world. The The cost of money changed. The way people work changed. The demand for physical office space changed. And none of those changes are reversing. If this sounds familiar, it should, because it has happened before. And the last time it happened, it destroyed over 1,000 financial institutions. In the mid-1980s, the United States experienced a commercial real estate boom driven by deregulation and aggressive lending. Savings and loan institutions, newly freed from restrictions on what they could invest in, poured money into commercial real estate development. Office buildings, shopping centers, apartment complexes, they financed all of it. The valuations were high. The interest rates were high too, but cash was flowing, and nobody asked hard questions about what would happen if occupancy dropped or if the market turned. By 1989, it turned. Vacancy rates in cities like Dallas, Houston, and Denver soared above 20%. Property values collapsed. Loans that had been performing just fine suddenly weren't. The buildings hadn't burned down. They were still standing. Hey, just weren't worth what the balance sheets said they were worth. And the institutions holding those loans didn't have enough capital to absorb the losses. Between 1986 and 1995, over 1,000 savings and loan institutions failed. The federal government created the Resolution Trust Corporation to manage the fallout. The total cost to taxpayers exceeded $130 billion. Adjusted for inflation, that's roughly $270 billion in today's money. Entire communities in Texas and the Southwest were economically gutted. Property values in some areas didn't recover for a decade. The lesson from the S&L crisis was not complicated. It was this. When the collateral underpinning a large volume of loans loses its value, the losses don't stay inside the real estate market. They migrate into the banking system. They migrate into deposit insurance funds. They migrate into the tax base. They migrate into the real economy. The building is just the beginning. The damage is in the wiring. That lesson was documented, studied, and published, and then, functionally, it was ignored. Let's talk about who holds the risk this time. In the United States, approximately 70% of all commercial real estate loans are held by regional and community banks, not JP Morgan, not Bank of America, not the institutions the federal government has designated as systemically important. The loans sit in banks with names most people have never heard of. Banks with $50 billion in assets, $20 billion, $5 billion. Banks that serve small cities and suburban counties. Banks that hold your neighbor's checking account and your town's municipal bond. This concentration is not an accident. It is the product of decades of lending incentives. Large banks, after 2008, faced tighter capital requirements and more regulatory scrutiny on concentrated real estate exposure. Regional banks faced less. They filled the gap. They became the primary lenders for the office parks, the strip malls, the mid-rise apartment buildings, and the mixed-use developments that define the commercial real estate landscape of Middle America. Now, those loans are maturing. And those banks are facing a question they do not want to answer publicly. What is the building actually worth? Because here's the uncomfortable part. Many of these banks have not marked their commercial real estate portfolios to current market value. They are carrying these loans at book value, the original amount, as long as the borrower is still making payments. This is technically permissible under current accounting standards. It is also, in practical terms, a form of delayed recognition. The loss exists. It simply hasn't been recorded yet. This is what the industry calls extend and pretend. When a loan matures and the borrower can't refinance at terms that work, the bank extends the loan, pushes the maturity date out 12 months, 24 months, modifies the term slightly, keeps the loan classified as performing. The building is still losing tenants. The value is still falling. But the bank's balance sheet looks intact. The strategy works until it doesn't, and the thing that makes it stop working is time. There's a direct historical parallel for this, and it played out across an entire generation. It happened in Japan. In 1991, after the collapse of Japan's real estate and stock market bubble, Japanese banks found themselves holding enormous portfolios of loans backed by properties that had lost 40, 50, sometimes 60% of their value. The banks did not recognize the losses. They extended the loans. They restructured them. They pretended. The government, unwilling to force the issue, allowed the banks to carry these assets at inflated values for years. The result was not a dramatic crash. It was something worse. It was stagnation. Banks that were technically solvent but functionally crippled could not make new loans. Businesses that needed capital couldn't get it. The economy didn't collapse, it froze. Japan's GDP growth averaged less than 1% per year for the entire decade of the 1990s. Some economists extend that period to 20 years. They call it the lost decades. The plural is intentional. Japan's banks weren't destroyed by the bubble. They were destroyed by the refusal to acknowledge that the bubble had already popped. And the cost wasn't borne by the bankers. It was borne by an entire generation of Japanese workers who entered a labor market that never recovered, who watched wages stagnate, who delayed families, who lowered expectations, who adjusted to a diminished future. The mechanism is the same. When banks carry bad collateral and refuse to write it down, they become zombies. They exist. They process transactions. They accept deposits. But they don't lend. They don't take risk. They don't fuel the economy. They sit there, consuming resources and producing nothing, hoping that time will heal what arithmetic cannot. That is not a Japanese problem. That is a structural problem. And it is exactly the playbook being followed right now in American commercial real estate lending. Let me show you what the numbers actually look like, because the numbers are where the story stops being abstract. As of late 2023, the national office vacancy rate in the United States crossed 13%. In some cities, it's dramatically higher. San Francisco's office vacancy rate exceeded 35%. Downtown Los Angeles exceeded 26%. Chicago's loop was above 22%. Washington, D.C., a market historically propped up by government tenants and lobbying firms, crossed 20% for the first time. These aren't temporary pandemic numbers. These are structural. Remote and hybrid work adoption has permanently reduced the square footage that companies need. It means 1 in 5 square feet of office space in America may never have a tenant again. Now connect that to the debt. A building with a 30% vacancy rate generates significantly less rental income. Its net operating income drops. And in commercial real estate, the value of a building is a direct function of its net operating income. The standard valuation method uses a capitalization rate, which divides the net operating income by a rate that reflects market risk and return expectations. When the income drops and the cap rate rises, which happens when interest rates rise, the property's value compresses from both directions. A building that was appraised at $100 million in 2021, with high occupancy and a low cap rate, might appraise at $55 or $60 million today. The debt on it hasn't changed. It still says $80 million on the loan documents. That's a $20 million gap. That gap is a loss. Someone will absorb it. The only question is who and when. You might ask why the government doesn't simply intervene, lower rates, backstop the banks, create a facility to absorb the distressed loans. And the answer is that they might. They probably will, in some form if the stress becomes visible enough. But intervention has costs that nobody mentions in the press conference. Let's talk about the trap. The Federal Reserve raised interest rates starting in March 2022 to combat inflation that reached 9.1%, the highest in 41 years. That rate hiking campaign is what made commercial real estate refinancing so expensive. If the Fed were to cut rates aggressively to relieve pressure on the CRE market, it would risk reigniting inflation, which would erode the purchasing power of every dollar held by every American. The Fed is not choosing between stability and instability. It is choosing between two different kinds of instability. If they keep rates elevated, the CRE refinancing wall becomes a slow-motion crisis. Banks take losses, some fail. Credit tightens, small businesses lose access to loans, local economies suffer. If they cut rates to ease the pressure, they signal that the Fed will always rescue asset markets, which incentivizes the exact kind of over-leveraged risk-taking that created the problem. And they potentially unleash a second wave of inflation in an election year, which has its own set of consequences. There's a third option, the regulatory approach. Extend the accounting flexibility. Allow banks more time to recognize losses. Let them amortize the write-downs over years instead of quarters. This was, in fact, done informally after 2008, and it is already happening now. In early 2024, regulators quietly signaled that they would give banks more latitude in how they classify and report troubled commercial real estate loans. But this approach has a name in financial history. It's called forbearance. And forbearance doesn't solve the problem. It delays the recognition of the problem. It is the mechanism that turned Japan's crisis into Japan's lost generation. It is the mechanism that allowed the S&L crisis to metastasize for years before Congress was forced to act. At this point, there are only three options. Absorb the losses now, delay the losses and hope values recover, or inflate the currency enough that the nominal value of the debt shrinks relative to the value of everything else. None of them are painless, and all of them have been tried before. Let's talk about who actually pays the price, because it is never the people who made the decisions. When a regional bank takes losses on its commercial real estate portfolio, the first people affected are the bank's shareholders. Their equity gets wiped out or diluted. That's the theory anyway. In practice, the shareholders of regional banks are often pension funds, insurance companies, and index funds, which means the losses flow to retirees, policyholders, and passive investors who never knew they had exposure to a half-empty office tower in suburban Phoenix. If the bank fails, the FDIC steps in. It covers insured deposits up to $250,000. But the FDIC's deposit insurance fund is not limitless. As of late 2023, it held approximately $120 billion. If multiple regional banks fail in a compressed time frame, The fund faces pressure. It replenishes itself through assessments on all banks, including healthy ones. Those costs are passed to customers in the form of higher fees and lower deposit rates. In other words, every bank customer in America indirectly pays for the failure of banks they never banked with. Then there's the municipal level. Commercial real estate is one of the largest sources of property tax revenue in American cities. When a building's value drops by 40%, the tax assessment eventually follows. That means less money for schools, sanitation, police, fire departments. Cities that are already financially strained, cities like Chicago, San Francisco, and Detroit, face a compounding problem. The buildings are worth less, so the tax base shrinks. Services are cut. The remaining businesses and residents face higher tax rates or worse services, or both. Some leave. The tax base shrinks further. This is the doom loop, and it has already started in several major American cities. The people who pay the price are not the developers. Many of them operate through limited liability entities specifically designed to isolate personal assets from project failures. A developer can walk away from a building, hand the keys back to the bank in what's called a deed in lieu of foreclosure, and still go home to a house in Greenwich. The loss stays with the bank. The bank passes it to its shareholders. The shareholders are your pension. Your pension is your retirement. That's the chain. Building to bank to pension to you. It's long enough that most people never trace it. But it's real. And it's already in motion in cities across the country. Now let me address the argument that this is manageable, that the system is resilient, that 2008 taught everyone lessons and the safeguards are in place. Here's what's different about this time, and not in a reassuring way. In 2008, the crisis was centered on residential mortgage-backed securities. The system that failed was legible in hindsight. There were identifiable bad actors, subprime lenders, ratings agencies, derivative desks at major banks. The government's response was concentrated. TARP was $700 billion aimed at a handful of systemically important institutions. The Fed's intervention was enormous but targeted. Commercial real estate in 2024 is different in structure. The exposure is dispersed across approximately 4,500 regional and community banks. There is no single institution whose failure would trigger a Lehman-style panic. Instead, there's a slow, distributed erosion. Dozens of banks quietly tightening credit, hundreds of buildings quietly losing value, thousands of loans quietly being extended. This is not a heart attack. It's a chronic illness. And chronic illnesses don't make headlines. They don't produce dramatic footage of bankers carrying boxes out of office buildings. They produce a slow, grinding deterioration in economic activity that is difficult to attribute to any single cause. We already saw early symptoms. In March 2023, Silicon Valley Bank and Signature Bank collapsed. While their failures were primarily driven by interest rate mismanagement in their bond portfolios, both had significant commercial real estate exposure. More importantly, their failures revealed a truth that regulators had been quietly worried about. The regional banking system was more fragile than the stress tests suggested. Deposits could move faster than anyone modeled. Confidence was thinner than anyone assumed. In early 2024, New York Community Bancorp, a regional lender with significant commercial real estate exposure, saw its stock price drop by more than 60% in a matter of weeks after it reported unexpected losses on its CRE loan portfolio and slashed its dividend. The market reaction was swift and severe, not because NYCB was systemically important, but because investors understood that if one bank was revealing losses, others were likely hiding them. That's the mechanism. One disclosure triggers reassessment. Reassessment triggers repricing. Repricing triggers loss recognition. Loss recognition triggers capital calls. Capital calls trigger asset sales. Asset sales push prices lower. Lower prices trigger more losses. This is the feedback loop. It doesn't require a single catastrophic event. It just requires the truth to surface faster than the system can absorb it. There's another dimension to this that rarely gets discussed, and it involves the commercial mortgage-backed securities market, or CMBS. Not all commercial real estate loans sit on bank balance sheets. A significant portion, roughly $650 billion, has been securitized, packaged into bonds and sold to investors. These securities are structured in tranches, just like the residential mortgage-backed securities that became infamous during the 2008 crisis. The senior tranches are rated AAA. The junior tranches absorb losses first. As of mid-2024, the delinquency rate on office loans within CMBS pools has been climbing steadily. TREP, the leading data provider for this market, reported that the office CMBS delinquency rate exceeded 7%, with special servicing rates, loans that have been flagged for potential trouble, running even higher. Some individual deals have delinquency rates above 20%. The investors holding these securities include insurance companies, pension funds, sovereign wealth funds, and bond funds that manage the retirement savings of millions of ordinary people. When the underlying loans default, the losses cascade through the tranches. The junior tranche holders get wiped out first, then the mezzanine. If losses are severe enough, Even the senior tranches take hits. Think about what that means. A teacher in Ohio with a state pension fund that holds a slice of a CMBS tranche backed by office buildings in San Francisco is financially linked to the work-from-home decisions of software engineers 3,000 miles away. She doesn't know it. She's never been told. She just sees her pension statement once a year and assumes someone is managing the risk. Someone was managing the risk. They were managing it by assuming office buildings would stay full and interest rates would stay low. Both assumptions failed simultaneously. And when two foundational assumptions fail at the same time, hedging doesn't work. Diversification doesn't work. The models break because the models were built on the world that no longer exists. There's a phrase that appears in almost every post-crisis investigation, every congressional hearing, every inspector general report. The phrase is, the risks were known. The risks of concentrated commercial real estate lending were known after the S&L crisis. The Resolution Trust Corporation published detailed studies. The FDIC updated its risk management guidelines. Congress held hearings. The risks of extend and pretend were known after Japan's lost decades. American economists wrote papers about it. Business schools taught case studies. The phrase zombie bank entered the financial lexicon specifically because of what happened in Tokyo. The risks of securitizing loans backed by potentially overvalued collateral were known after 2008. Dodd-Frank was passed. The Consumer Financial Protection Bureau was created. Stress tests were mandated. And yet, here we are. The same pattern. Cheap money fuels over-leveraged investment in real estate. Valuations detach from fundamentals. The debt remains fixed while the collateral value decays. The institutions holding the debt delay recognition. The losses accumulate silently, and eventually someone pays. This is not a failure of knowledge. It is a failure of incentive. Every actor in the system behaved rationally within their own time horizon. The developer borrowed because the terms were favorable. The bank lent because the fees were lucrative and the regulators weren't objecting. The investor bought the CMBS tranche because the yield was attractive and the rating was investment grade. The regulator approved the framework because the system appeared stable. Everyone optimized for the present. Nobody priced in the structural shift. And that's the trap. The system doesn't fail because of villainy. It fails because every participant is incentivized to ignore the accumulating risk until the accumulation becomes irreversible. Let me leave you with this. As of right now, the total value of commercial real estate in the United States is estimated at approximately $20.7 trillion. The total outstanding commercial real estate debt is approximately $5.8 trillion. The portion of that debt maturing in the next 24 months exceeds $1.5 trillion. The average interest rate on those maturing loans is between 3 and 4%. The current market rate for refinancing is between 6.5 and 8%, depending on the property type and borrower quality. That spread, 300 to 400 basis points, applied across hundreds of billions of dollars of loans against properties that are worth 20, 30, sometimes 40% less than they were when the loan was originated, is not a gap that can be bridged by optimism. It is not a gap that closes with a single rate cut. It is a structural repricing of the most leveraged asset class in the American financial system. The buildings are still standing, the glass is still intact, the elevators still work, but the financial architecture underneath them, the loans, the valuations, the collateral assumptions, the bank balance sheets, the pension fund allocations, the municipal tax projections, all of it was built on a set of conditions that have fundamentally changed. This is historical and educational analysis, not financial or investment advice. The pattern is familiar. Cheap money creates overvaluation. Overvaluation creates overleveraging. Overleveraging creates fragility. Fragility waits for a trigger. Sometimes the trigger is dramatic. Sometimes it's just a loan officer in Missouri telling a developer in Chicago that the appraisal won't support the refinance. The question was never whether commercial real estate would adjust. Every asset class adjusts. The question is how the losses are distributed, whether they are recognized early and absorbed by those who took the risk, or whether they are delayed, disguised, and eventually transferred to people who never knew they were exposed. History is unambiguous about which outcome is more common. The floors are dark, the loans are maturing, the math hasn't changed, and the pattern, as always, is already in motion. This channel exists to trace the fault lines before they become front-page news. If understanding the architecture of financial systems matters to you, consider subscribing. Most of these patterns only become visible in hindsight. The point is to see them before that.